Hello. Thank you for joining Mayor Brown's Global Financial Markets teleconference series. Today's call is entitled A New Era for Qualified Mortgages, CFPB Finalizes QM Rules. My name is Kris, and I'm a partner in Mayor Brown's Washington, D.C. office and a member of the Consumer Financial Services Group. I concentrate my practice on federal and state regulatory compliance matters affecting providers of consumer financial products and services. First, a couple of housekeeping items. As regular listeners will know, this call is being recorded. We will be emailing an audio link to all participants so you can listen to the teleconference again or forward it to your colleagues. In addition, the recording also will be available as a podcast on your preferred podcast platform. Since we will not have a Q&A session, please send your questions regarding today's topic by email to gfm@mayorbrown.com. That is the same email address on your invitation email. We will respond promptly. Joining me today is Larry Platt. Larry is a partner in Mayor Brown's Washington, D.C. office and a member of the Financial Services Regulatory and Enforcement Practice. He concentrates his practice on a range of matters related to real estate finance, mortgage banking, and consumer finance in both the primary and secondary markets. With those introductions, we will now begin today's discussion. First, I'd like to set the stage for those of you who may not have joined us in July when Larry and I discussed the proposed rulemakings, or even if you did, the Dodd-Frank Act of 2010 included a requirement that a creditor of residential mortgage loans must make a good faith, reasonable determination of a borrower's ability to repay a loan based on the consideration of specified factors, including income and other financial resources other than the consumer's equity in the dwelling. So this was post-crisis legislation designed to address concerns that Congress and even the Federal Reserve before then saw as irresponsible home loan lending that led up to the crisis. Lending such as no-doc loans, negative amortization, reliance on loan-to-value ratios as the primary determinant of creditworthiness. A violation of this ability to repay requirement in the statute may result in the potential award of substantial money damages to borrowers with an extended limitations period, meaning that borrowers could sue the creditor for up to 3 years, and the borrower has the ability, even after that 3-year period expires, to assert a violation of the requirement against the holder of the loan if and when the holder seeks to foreclose. According to the Dodd-Frank Act and subsequent regulations, certain loans called qualified mortgages are deemed to comply with those ability to repay requirements, and that provides lenders and subsequent holders of the loans with some compliance certainty. Importantly, then, there's a trade-off. Making a QM provides a lender safe harbor from regulatory actions and from borrower challenges, but it also cuts off a borrower's right to challenge the underwriting because a QM is deemed to comply with the rule. So where do we draw the line in order to promote the availability of safe and affordable mortgage lending? Well, after public outreach efforts, the CFPB has now issued 3 final rules establishing what will constitute a QM going forward. Generally, these rules take effect in approximately 60 days. First, the CFPB is discontinuing the so-called GSE patch, which provided that any loan eligible for sale to Fannie Mae or Freddie Mac constitutes a QM. That GSE patch will be available past its originally scheduled expiration date, which was in January, to allow time to transition to a new QM regime, which brings me to the second QM rulemaking. So secondly, the CFPB is revising its definition for general QMs, the highlight here being that a loan will be a QM depending largely upon its pricing. A loan's annual percentage rate must be within 2.25 percentage points of the average prime offer rate in order for the loan to be a QM. QM status will not any longer depend on the loan's debt-to-income ratio, or DTI, although a lender will be required to continue considering DTI. In the third final rule, which Larry will discuss, the CFPB also is implementing a concept under which a loan may become a QM through a seasoning process, 36 months of timely payments. So we'll discuss each of these three rulemakings. First, the GSE patch elimination. The CFPB has repeatedly stated that it had no intention of extending the expiration date of the GSE patch, which again is the QM for Fannie-Freddie eligible loans, unless that extension was necessary for a brief transition period. That expiration date was set for January 10th, 2021. What are we talking about when we mentioned the GSE patch? Well, when the CFPB first issued regulations to implement the Dodd-Frank Act's ability to repay requirements, it established a temporary set of loans that would be deemed to be QMs and receive that QM compliance certainty. That temporary QM category covers any loans, as I mentioned, that are eligible to be purchased by Fannie Mae or Freddie Mac, the GSEs. The GSEs will, under certain circumstances, purchase loans that otherwise would not fit within the CFPB's general QM parameters, particularly loans that exceed the otherwise applicable 43% DTI ceiling, or loans that didn't exactly follow the CFPB's consideration and verification standards in Appendix Q. The CFPB's hope with that temporary GSE QM was that at the time the mortgage markets would begin to stabilize, private capital would return, so this GSE QM was only needed temporarily. As that January date approached, there has been a lot of discussion about that set of GSE patch loans, which would not otherwise be deemed a QM. Those patch loans represented a large and persistent share of originations in the conforming mortgage market. If the patch were to expire and those loans were not deemed QMs, would lenders make those loans? Should lenders make those loans? That brings us to the second rulemaking. The CFPB determined that allowing the patch to expire without addressing changes to the general QM definition could significantly reduce access to responsible, affordable credit. So the CFPB went back to the drawing board, considered all the statutory and regulatory aspects of the QM definition, and thought about how to shape QM going forward. As you've likely heard by now, the CFPB proposed and has now finalized the elimination of the 43% DTI cap for QMs. Going forward, as Larry will discuss in just a moment, a lender will still be required to consider DTI or residual income in order to originate a compliant QM loan, but the CFPB will no longer impose a threshold or a ceiling on those calculations. With that, the CFPB also is eliminating Appendix Q, which, as I mentioned, dictated the way creditors were required to consider and verify a borrower's income and debt obligations. Instead, the regulations will distinguish QMs from non-QMs by relying on the loan's pricing. Under the CFPB's new approach, a first lien loan will be a non-QM if the APR exceeds the average prime offer rate, the APOR, by 2.25 percentage points or more. That threshold, that spread, would be higher for smaller loans or for subordinate lien loans. The CFPB asserts that the loan's price, its rate spread over APR, is strongly correlated with loan performance and early delinquencies, and as such is a good proxy for the consumer's ability to repay. Other metrics may be correlated, and the CFPB looked at lots of different standards. But this APR spread has the benefit of being clear and objective, in addition to being a strong indicator of early delinquencies. It rejected certain proposals that others had made, such as keep a DTI test, raise it above 43%, but authorize certain compensating factors. The CFPB believed that that would not be a better test. The CFPB's final rule adopts an APR spread that's higher than in the proposed rule. The proposal had suggested a 2.0 percentage point spread over APOR, as opposed to the final rule's 2.25 percentage point spread. Again, it's a balancing act and a line drawing exercise. The CFPB considered the data and determined that 2.25% spread strikes the best balance between ensuring consumers' ability to repay and ensuring continued access to responsible, affordable mortgage credit. The final rule continues to distinguish QMs that receive a safe harbor of compliance from those QMs that receive a rebuttable presumption of compliance, depending on whether the QM's APR exceeds the APOR by the same 1.5 percentage points. So that part of the rule remains. Some other things that remain, the final rule continues to provide that in order for a loan to be a QM, it must still meet the product feature limitations, the 3% limit on points and fees. In fact, the ability to cure a points and fees mistake by refunding the excess to the borrower within 210 days will soon expire. So the 3% limit on points and fees is a hard limit going forward. In addition, a lender would still be required to consider and verify the consumer's income or assets and debt obligations, and as mentioned above, would still have to consider the consumer's DTI ratio or residual income. While the CFPB proposes to remove the instructions in Appendix Q, the agency still expects lenders to verify the consumer's current or reasonably expected income or assets other than the value of the dwelling and the consumer's current debt obligations, alimony, and child support using reasonably reliable third-party records. In this regard, there is no difference between QM and non-QM loans on the requirement to verify income. For purposes of compliance with that requirement to verify income, assets, debt obligations, the CFPB adopted its proposal to provide a safe harbor to lenders that use specified verification standards from the GSE's guides, Fannie Mae's selling guide, Freddie Mac's selling guide, or from the handbooks of FHA, VA, or the USDA. The CFPB actually spelled out in its final rule the very specific versions of those guidelines that will qualify for the safe harbor. The final rule would allow a lender to pick and choose from among those standards for that purpose. However, lenders do not have to rely on those specific agency standards. They can, and I think the CFPB hopes that they will, consider other innovative but reasonable methods of verification. But they would receive the safe harbor of compliance with the verification standard if they use those specified agency guidelines. The final rule maintains the proposed rules approach of not prescribing any particular underwriting standard, but it will require the creditor to maintain written policies and procedures and documentation of how the creditor has considered and verified those factors. With that, I'll turn it over to Larry to discuss some other aspects of the QM rule.
Thanks, Kris. So I first want to follow up on the consider element. So determining the amount and sufficiency of personal income obviously is at the heart of the verify and consider requirement. And Kris mostly talked about the verification side, which I think of as really just loan processing. And I want to talk a little more about the agency's approach to decline to prescribe safe harbor underwriting requirements. But let me just start with the conclusion, and I think Kris already said it. The final rule maintains the approach of the proposed rule to eliminate any prescribed mandatory standards for underwriting a loan. So in thinking about this, it's useful to go back to the beginning and the original language of the ability to repay requirements in the Dodd-Frank Act. A lot of people don't remember, or maybe they didn't realize, that the GSE patch and the 43% DTI calculated in accordance with Appendix Q are not in the statute for ability to repay. Congress didn't include a specific underwriting requirement. It did prescribe a cap on points and fees. It did prescribe a restriction on non-traditional loan products, and it did prescribe a requirement to document income. But rather than dictate an underwriting requirement, Congress simply granted broad discretionary authority to the CFPB to promulgate regulations regarding underwriting elements if they so chose. And the CFPB did. They exercised that authority in creating the GSE patch and the alternative 43% DTI limitation. And in effect, it's now returning to the roots of the original legislation. The proposal obligates a creditor, the final rule obligates a creditor to consider the consumer's income or assets, debt obligations, alimony, child support, and monthly debt-to-income ratio or residual income based on what has been verified. But it doesn't tell you how to evaluate these. So the approach empowers a creditor to set its own standards, but it requires the creditor to document the loan file evidencing the creditor's application of its own underwriting requirements. So even though it says that you have to consider DTI or residual income, it also says in the preamble and the regs that a way of considering DTI or residual income is establishing monthly thresholds and then exceptions to those thresholds based on other compensating factors, and of course documenting application of the thresholds. You don't really need to say that because you can do anything, but at least that gives you some guidance on that. But let's take, for example, let's just take a real life example. Let's say you have a creditor whose underwriting standards combine LTV with DTI. Now first, loan-to-value ratio really has nothing to do with ability to repay. It may go to the likelihood of loss or the severity of loss or the willingness to repay. But generally speaking, it's not a factor that goes into the question of ability to repay. But let's say, nevertheless, we often find LTV criteria that with a sliding scale on DTI. So the lower the LTV, for example, the higher the permitted DTI, subject to a cap that can be exceeded only based on the presence of compensating factors. So if a borrower wanted to challenge whether the loan in fact was a QM loan under this new rule, it couldn't challenge the propriety of this methodology. It only could challenge whether the creditor actually applied the stated methodology and documented that application in the loan file. So does it make sense? I mean, couldn't that lead to a lot of different abuses? Well, reasonable people could disagree, but here's how the thinking goes. First, many of the prior abuses were more about verifying the sufficiency and sustainability of income, but not how documented income should be evaluated. Second, maybe this will change, but there's not a tremendous concern that the agency's underwriting standards are irresponsible. And what the final rule does is effectively dilute the comparative advantage standards that GSEs now enjoy because of the GSE patch, and so it may promote private securitization, but at the same time, without even using the words GSE, it effectively includes GSE underwriting and verification in the definition of QM. It just doesn't say that. I think the new rule facilitates the development of private automated underwriting models, even though the contents could remain confidential, although you're going to have to show that you consider DTI or residual income. And frankly, we think, and the final rule explicitly addresses the encouragement of the development of standard setting organizations to issue best practices. So another thought, and this may prove to be wrong, that the riskier the underwriting standards are, the more likely that investors will demand increased yield to compensate for assuming the risk, and thus risky loans, which a originator would have authority to make under QM, may fall outside of the price parameters based on the spread over APOR. But this may not be true. I mean, investors could chase production and steady yield, and that's something we have to watch for. But there's some spillover consequences that we just wanted to highlight based on this approach. Remember that private mortgage securitization requires risk retention, but qualified residential mortgages are exempt from this risk retention. And presently, the definitions of QRM and QM are parallel. So what that means is upon the effective date of the new QM rule, it will automatically slide over to private securitizations and be the same rule for QRM related to risk retention. Now, there are different regulators. It's not just the CFPB that's involved in determining risk retention in QRM. Those regulators did a request for information, I think it was late last year, ending in February of this year, for thoughts on whether the risk retention rules should be changed. And late in the summer, they said that they would be postponing until June of next year their consideration of any changes to QRM. So we know that this new rule will automatically extend to QRM at least through June 2021, and if it's going to be changed, if the regulators want to decouple it, they'll have to propose new regulations to do that, or they may decide to keep it the same. The second thing, and this is one that a lot of our clients have already been asking us about, is whether these final regs could cause loans that now only fit in non-QM to fit within QM. So, as Kris said, loans that exceed the points and fees limitations or use non-traditional loan products still only can be done in the non-QM world. But loans based on non-agency underwriting standards with DTIs in excess of 43% can fit into QM. So, for example, prime jumbos with an accept certificate from a GSE automated underwriting engine could be QM. So could prime jumbos with an accept certificate from a bank's proprietary automated underwriting system, assuming the lender can show that the AUS considers DTI or residual income and that income is documented in accordance with agency standards. How about a self-employed borrower bank statement program using non-agency documentation standards? Would that fit in QM? Well, potentially it could, but given that a borrower always can challenge whether a loan is a QM loan, a borrower can challenge the sufficiency of the documentation and whether it violates the verify standard. So as Kris said before, the verify standard is no different whether it's a QM loan or a non-QM loan, but without a documentation safe harbor to satisfy the verify standard, like using agency standards, there's no objective certainty that a self-employed borrower bank statement program will qualify as a QM loan because it may well not satisfy the documentation standard or the verify standard. So we expect that underwriters are likely going to push back on securitization of what may be perceived to be risky loans that the issuer tries to squeeze into a QM private securitization. One of the risks, there's not just the legal risk of whether a borrower could challenge whether the loan is a QM loan or not, or the securities risk about, misstatements in an offering memo. But if a securitization is structured as a QM securitization for which risk retention is not required, and in fact the loans weren't QM loans, then you've really got a defective securitization because there's not the risk retention that otherwise would be required. So we expect rating agencies and underwriters to look really closely at what traditionally were non-QM loans and whether they can squeeze into QM status. So could the lack of a prescribed underwriting standard lead to irresponsible lending? So how about a 95% DTI loan with fully verified income? Well, theoretically it could. The bet is that those loans will be priced above the threshold to account for the heightened risk. But one thing I expect the advocacy groups to do in a new administration is perhaps try to amend the regulations and add some, I guess you'd call them some breaks, just to make sure that there's certain practices that are deemed to be irresponsible and therefore not quote unquote considered. So with that, let me turn it back to Kris.
Great. Well, we I think Larry hit most of the highlights. I just wanted to kind of interject and just say that I think it's interesting. It'll be interesting to see how the market reacts. Many lenders, I think, are likely to rely on the agency guidelines, use that safe harbor, pick and choose among the requirements. It allows them to avoid Appendix Q, which I think is welcome relief. Appendix Q was outdated. It had lots of holes. It arguably prevented consideration of many types of stable income, and just presented, a lot of hiccups for lenders. So I imagine that the reliance on agency guidelines will still be, an important guardrail, and I imagine the APR ceiling will also be kind of a hard guardrail. But as Larry mentioned, I think this will provide some additional opportunities for lenders to use some innovation to address non-traditional types of income, self-employed borrowers, gig employment workers, and others, although there still will be some level of uncertainty. Larry, are you going to cover the seasoning rule, or is that for me to do?
Yes, I was going to.
Okay, go for it.
On seasoning, there was a third part of the regulations relating to QM, as Kris mentioned, the last one being seasoning. And so, there's long been this question, if a borrower is successful in actually making payments on a loan for some period of time, hasn't the borrower, in fact, demonstrated the ability to repay? Can't you infer, by virtue of payment over a period of time, that the borrower can repay the loan? So some of the comment letters to the CFPB's original request for information on QM a couple of years ago suggested the use of such an approach, that if a loan was seasoned, even if it didn't originally qualify as a QM, based on positive performance, it should morph into a QM loan. And that concept, in part, was taking a page out of the GSE's representations and warranties and remedies frameworks that provide that the GSEs won't demand repurchase of a loan for a breach of a loan level underwriting rep and warranty if a 36-month seasoning requirement without material delinquency is met. So the proposed rule basically adopted that concept, that for a loan to become a loan could become a safe harbor QM after 36 months of timely payments. But they added the somewhat curious restriction that seasoning exemption would be available only if the originating creditor held the loan in portfolio during that 36-month period, which effectively just made that exemption available to depository institutions. The final rule adopted this 36-month seasoning requirement, but it extended its eligibility to loans sold or transferred before the end of the seasoning period. But then what it giveth, it taketh away. It could go to a single purchaser during that seasoning period, but not if that purchaser was part of a securitization transaction. For some reason, the securitization is considered it goes back to the old question about whether there's skin in the game. So how do you define timely payment? In order to be deemed timely, much like the way the GSEs do it, the loan must not have been more than 2 delinquencies of 30 or more days, or any delinquencies of 60 or more days at the end of the seasoning period. The servicer may choose not to treat a payment as delinquent if it's deficient by only $50 or less, but they can't do that more than 3 times during that 36-month period. And then there's other criteria and exemptions for determining whether payments are timely. One odd thing about this seasoning rule, so as written, it's available only for first lien fixed rate mortgage loans. It has to satisfy the product feature requirements and limits on points and fees. But it also says that the creditor has to have complied with the same consider and verify requirements that apply to the general QM loans. So if you otherwise have to comply in order to get the benefit of this seasoning exemption, what's the value of the seasoning exemption? We're not really sure that it really is that worthwhile, other than maybe on causing a rebuttable presumption loan to become a safe harbor conclusive presumption loan. But we're trying to figure out, is it really worth that much, this exemption? Kris, do you want to talk about timing?
Sure. So the CFPB's, three slate of final rules, came out recently. They provide that the GSE patch will expire on the same date that compliance with the revised QM standards, these APR standards, become mandatory. That mandatory compliance date is July 1st, 2021, 7 months from now approximately. So that a creditor may decide to make loans in accordance with the new general QM parameters based on the APR spread, beginning on the rule's effective date, which will be 60 days after publication in the Federal Register. To my knowledge, that has not yet occurred, so likely the effective date will be at some point in late February. This helps to resolve a bit of a gap that had been noticed in the proposed rulemaking, where there was this short period of time where neither of the QM standards appeared to be in place. But here, creditors can go ahead and move into the new non-patch APR world, or they can stay in the 43% DTI patch world. But as of July 1st, 2021, the patch will expire, and to make a QM, lenders will need to comply with these new standards. Similarly, the seasoning QM will become effective for loans applied for on and after this date, that is 60 days after the rule is published. So existing loans will not get the benefit of this seasoning approach, but new loans applied for on and after that date in late February will be allowed to season into the QM status. So with that, we'd like to close off today's Global Financial Markets teleconference. Thank you to our audience for tuning in. A few brief reminders. You will receive an email with a link to the recording of today's call, and the recording will also be available as a podcast on your preferred podcast platform. If you have any questions related to today's content, please email them to gfm@mayorbrown.com. Thank you again for your participation, and you may all now disconnect.